Right. So McDonald's, obviously, this is a staple business, a company that needs no introduction, but we'll introduce it anyways. The
It's
largest
probably not the
restaurant,
next Ham and Power right now from
probably
here,
not
is
the
what you're
next
saying. Yeah.
company to produce a 2 to 300% return, but
Very
certainly a
stable.
business worth looking at. As Ryan said, strong Q3 results today. We're going to take a look at those, a 10% dividend increase. So McDonald's Corporation, the symbol is MCD, trades at $260 per share. It's about $190 billion market cap, and they are the largest restaurant owner operator in the world. 40,000, over 40,000 restaurants in 119 countries. So, in terms of performance, if we look at the company's performance over the last 10 years, pretty impressive. Stock price up about 160% or so over that period of time. Over the last year, less impressive, quite a bit of volatility and a fairly big or moderately large decline from July until just recently it started to trend back up again. But the Q3 results came out today. They were received relatively well from the market. Let's take a look here. So revenues were 6.7 billion approximately, up 14% year over year. They produced comparable same restaurant sales growth of 8.8%. That's compared to 9.5% in the third quarter of last year. Operating income 3.2 billion, up 16%, and earnings per share $3.17, up 18%. Just taking a look through the conference call and the press release, there are a few notes from management that were worth highlighting. One is that comparable sales growth was primarily the result of price increases. So the company has been increasing prices due to inflationary pressures. We did not see a significant increase in the number of stores, and as well, the revenue growth beyond the same store sales growth was primarily then the result of currency exchange. So we're looking at performance mostly being propped up here by price increases and not an expansion in the size of the network or anything else. Margins do remain under pressure due to continued cost inflation. So that's an issue looking forward. And the company believes that there are macro headwinds that are going to continue to persist into the fourth quarter. And they plan to help their franchisees with this, which they believe will impact their full year results by about 100 to 150 million. They did note that strong Q3 results should provide a positive tailwind for the full year of 2023. Now, what I read out of this is that likely they're expecting Q4 results to be a little bit weaker if they're highlighting that Q3 is going to prop up the year. But certainly it's not a situation where, yeah, they put out a strong Q3 report, but it's not a situation where the outlook is necessarily fantastic. Looks like there are several headwinds that are continuing to face the company. Balance sheet, about 48 billion in debt, 2.2 billion in cash, negative equity. So, negative equity is a tough one to look at. These are accounting items, but at the same time, you don't want to see negative equity on a company's balance sheet, ideally. So the equity being the assets minus the liabilities. And what this is basically saying is that the liabilities are more than the assets and that the shareholders don't own anything. Now, the real value of the assets may not be what they are recorded at on the balance sheet, especially in the case of McDonald's, where a lot of the value is going to be just in the brand. So the way accounting treatments work, we might not look at the equity and think that that's necessarily a reliable figure, minus 5 billion, but it's still not an ideal situation to look at a company's balance sheet and see a negative value on the shareholders' equity line. But just in terms of the debt leverage for the company on a net debt to EBITDA, adjusted EBITDA basis, trading just under 4 times. I would consider that to be fully leveraged. I mean, this is a restaurant business. It's fairly capital intensive. So we would expect to see higher balance sheet leverage in a case like that. I don't think that their balance sheet is over leveraged. It's nothing that I'm considering really concerned about. But at the same time, I don't see a lot of room to increase the leverage ratio from here. And then looking at the future growth based on analyst estimates, as well as valuation. So analysts on average are estimating about 10.91 per share in earnings for the current year, and that growing to 11.70 next year. So 8% earnings per share growth this year, 7.2% earnings per share growth next year. and the stock trading at 24 times current year's expected earnings, 22 times next year's expected earnings. So when we look at the average price to earnings multiple of McDonald's going back for about a decade, the P ratio is really averaged in that 20 to 22 times, but I found that, it's really been the last 5 years that it's been increasing. So the trend is that the valuation has become more expensive over the past decade, but right now, we're more or less sitting at about the average, maybe a little bit more expensive than the average. Another thing I wanted to do is just take a look at how the company's historical growth rate has looked going over the last 10 years. And, here we really don't see a really clear growth trend. Certainly there's been a little bit of growth over the last couple of years, but revenues were largely in decline from 2013 to 2020. Then we've seen some recovery since then, fairly flat revenue last year in 2022 compared to 2021. And then we had some good revenue growth in the quarter, but it's not a situation where this is a company that is putting out consistent growth in revenue, really even at a low level. So that's something to consider. Our take on the company, the fact that it is an extremely strong brand, that gives it some value right there. I think that it's a reasonably defensive business being in the fast food space. Fast food restaurants are generally thought of as being defensive businesses and more insulated from an economic slowdown. And this largely has to do with a low cost to calorie ratio of their food. So you get a lot of bang from your buck from a calories perspective when you buy fast food. They've shown ability to pass price increases on to customers. So that's impressive as well. But it is a very mature business. There's really a lack of sustained long-term revenue growth. We're not seeing a significant expansion in the number of restaurants in the network. We're not seeing significant same-store sales growth outside of price increases. So that's something to consider. Balance sheet, not ideal. I don't think that it's a horrible balance sheet, certainly not on a leverage ratio basis. But it's not perfectly clean either. So our take on the company, it's a solid business. We believe largely should produce stable performance. They are a dividend payer, pay about 2.8% yield right now, grew their dividend at 10%. So there's some value there long-term in the business, but we think that it's fairly valued in the near term.
So yeah, I've actually brought this quote up a few times, but just like seeing the valuation there that you have, Aaron, and like lack of long-term growth really that we're seeing right now. So it's 25 times earnings, roughly, correct? Or it was 24, 25
about 24 times current years, dropping to 22 next year.
And this is a quote that I brought up on the podcast before, but Peter Lynch uses an example where he says, wonderful companies become risky investments when people overpay for them. And he talks about basically McDonald's as an example where in 1972 the stock was bid up to about 50 times earnings. And he says, with no way to live up to these expectations for growth, the price fell from $75 to about $25 per share, which he indicated at that time was a great opportunity to buy at a more realistic 13 times earnings. Now, of course, that's all the way back in 1972.
I'm guessing probably less mature, better growth back then. That might have been what a lot of the excitement was about.
Exactly. So, seeing that they're at that, 25 times, kind of, in between that 50 and 13 times growth is it's mature. It's more of a dividend payer. The leverage is high. I would definitely agree with, your conclusion there that it's trading closer to fair value.
I would say fair value right now. I mean, it's not, yeah. I wouldn't consider an obscene valuation, but I don't look at that valuation and see, especially given the fact that, revenue growth hasn't really been that impressive historically over the past 10 years. In addition to that, the company's talking about headwinds as well. So, if this were a company that was growing their revenues and their earnings at 10%, fairly consistently, then I would be, more inclined to think that was a good valuation. But
yeah. And like, if you look back 10 years ago, they did, was it 28 billion in revenues, and they did 23 on a trailing basis. So they're actually down as far as I understand in terms of revenues over the past 10 years. I think we got a question on them in last week's client chat. and it was a comparison between them and PepsiCo actually, but not direct comparables, but kind of iconic brands for sure. And Pepsi itself had grown over that period from 66 billion to 91 billion in terms of revenues. And you were paying roughly a similar multiple, I believe, for the two. So better growth over the longer term, particularly in terms of revenues. And I thought they were paying relatively similar dividends. So, cursory overview, although I think McDonald's has accelerated its growth a little bit in recent years, has it not, Aaron, in the last couple of years?
Well, the last couple of years, the growth was better. And then this year,
but is it coming off a pandemic low, or, I'm not
this
sure.
year, the revenue growth has been good, but there are the margin pressures. So,
Yeah. So, I mean, there probably are some better options potentially at lower valuations. I mean, it's an iconic brand. Is there continued expansion across the globe? Probably, but they've hit, certainly over the past 10 years, they haven't been able to grow. So are they going to be able to grow? They're fighting also against health trends, you would think too, as well. So that is one issue globally for the company.